Hi there. Today we're talking about sellers, ways that you can defer, reduce, or eliminate your taxes. Here's our disclosures for all those legalese out there. My name is Matt Chansey. I'm a certified financial planner, a private wealth manager, and some consider me a financial expert. These are some less common tax strategies that you can actually use to defer, reduce, or eliminate your taxes when you're selling a highly appreciated capital asset. Most people are unfamiliar with these because it's just not something you uncover or you use on an annualized basis. Now, that last list did not even include any potential charitable strategies. So these are some other charitable strategies you can include to potentially use for tax mitigation as well. Today we're going to talk specifically about Code 1031 and Code 1400Z. There are some less common tax strategies. So what's a Code 1031? Well, it's also considered a like-kind exchange, and it's a swap of one investment property for another with the taxes being deferred. Most swaps are taxable, but if you meet the 1031 requirements, you'll be able to defer the taxes until you pass away, and your heirs will avoid those taxes by receiving what's called a stepped-up basis when you ultimately pass away. Now, a 1031 exchange is a swap of properties that are held for business or investment purposes. Exchange properties must be considered like-kind in the eyes of the IRS for capital gains or taxes to be deferred, but there's no limit on how many times or how frequently you can do a 1031 exchange if it's done properly. The rules can apply to a former primary residence under very specific circumstances. Well, what do you need to know? Well, you can't take constructive receipt of the money. It has to end up going to what's called a qualified intermediary for them to hold the funds. You have 45 days to identify a new property to purchase. You have 180 days to close on that new property. The new property must be of equal or greater value, and any debt associated with the new property must also be of equal or greater value. If you do not meet those requirements, any excess could potentially be caused as taxable boot, which means just a portion of the transaction would ultimately be exposed to long-term capital gains. Now, little known facts that most people are unaware of is that 80% of non-institutional exchanges don't close. Non-institutional exchange buyers typically overpay by an average about 15%. Why is that? Well, when sellers know that the funds are coming for your exchange, if they know they're coming from a qualified intermediary, then they're less likely and less willing to negotiate with you on price. They're going to hold your feet to the fire because what they know is that sellers know that you overpaying for that replacement property will ultimately cost you less than paying the taxes. So, what's a Delaware statutory trust? It's a fractional investment in a stabilized, cash-flowing institutional piece of real estate. Investors retain the capital appreciation and the cash flow based on a fractional interest. The property is going to be managed professionally, and you're exchanging into an institutional quality piece of real estate that is already stabilized and cash flowing. So, a like-kind exchange can include any real estate held for productive use or trade in business or for the investment purposes is considered like-kind. So what are some examples? Well, multifamily or apartments can be exchanged. You can exchange into hospitality or hotels, self-storage facilities, student housing, senior housing, industrial or distribution centers, think Amazon, manufactured housing or mobile home communities, mineral rights, oil and gas, grocery-anchored retail centers, medical office buildings, traditional office buildings, and necessity-based retail. So all of those asset classes you can exchange into them. Now, why would you want to do it? What are the benefits? So multiple owner real estate investments offer the following benefits. You get to diversify your portfolio of real estate. You get passive ownership, potential tax advantages, maximizing your cash flow. We can usually improve your cap rate, potential capital appreciation on your fractional interest, and real estate's an inflation hedge over time. But best of all, no more toilets, no more tenants, and no more trash. So wouldn't it be awesome if you could own a fractional interest of that apartment complex, let somebody else do all the work for you, and then you receive mailbox money every single month when you receive your fractional dividend checks and distributions. So what's the difference between that and a qualified opportunity zone investment? Well, a qualified opportunity zone investment is an investment into the development and construction of a brand new piece of real estate. So it's similar to a Delaware statutory trust, is that you own a fractional interest with other accredited investors, with the property going to be managed by an institutional general partner. The difference here is that we are building the asset from the ground up, or it could be a 100% renovation. It will require stabilization of the tenants before it can cash flow. Now, what type of assets can we buy into? Very similar as with the Delaware statutory trust: multifamily, self-storage, healthcare, student housing, office buildings, retail centers, industrial warehouses. What are the potential benefits? All very similar, right? We're going to diversify our real estate portfolio, passive ownership, potential tax advantages. We can get a better cap rate. We'll get potential capital appreciation, especially because we manufactured the asset. There's a lot of value add when you're building the real estate yourself. It's an inflation hedge. And then one thing that makes a qualified opportunity zone investment different is once that asset becomes stabilized at around the 2 to 3 year mark, they switch over from the construction financing and put long-term debt. When they do, there's typically a tax-free debt refinance distribution at stabilization. Think of it as taking a home equity line of credit and having it distributing to you on an institutional asset. Once again, no more toilets, no more tenants, no more trash. So this is an example. On the right, you're buying into existing cash flow. That's a DST. On the left, we're manufacturing that apartment complex, which is going to take us 2 or 3 years on the left to create what's on the right. So the difference is that a DST buys into existing cash flow via Code 1031, and a QOZ has to build the asset on a specific piece of real estate to get those tax benefits. With a 1031 DST, cash flows start right away. You'll get your paycheck within the first month. But with a qualified opportunity zone investment, it typically takes 2 to 3 years to build the asset and stabilize the occupancy so that it can start generating income to distribute. Now, we regularly have a pipeline of over $1 billion that we've looked at in both categories, between a combination of Delaware statutory trust and qualified opportunity zone funds that fit your replacement and tax planning needs. So if you have recently sold any highly appreciated capital asset, whether it's real estate, an operating business, and/or stocks and bonds in your portfolio, we have a pipeline of institutional quality assets that we can show you that would help mitigate taxes and let you diversify into institutional real estate. My name is Matt Chansey. I'm a private wealth manager and a financial expert, and today this was Little Known Tax Strategies. I hope you enjoyed it.